You've probably seen the headlines. A historic $124 trillion is moving between generations. So, are you waiting on a payday? This is a chart mapping out the largest wealth transfer in history. On the left side, we have the baby boomers and the silent generation, the people who currently hold the assets. On the right, millennials and Gen Z, many of whom are hoping this money will help them finally buy a house or clear their student debt. If you follow the paths on this diagram, you see a massive volume of wealth flowing toward those younger generations. The expectation is a generational windfall. But economists are warning people not to budget for a generation-wide financial bailout. The $124 trillion figure is a macroeconomic overestimation. For many families, the reality of end-of-life costs and taxes means the windfall they're expecting will be significantly smaller by the time it arrives. To see where that money actually goes, you have to look at this transfer as a funnel. Before a single dollar reaches an heir, we have to subtract the massive costs of aging. End-of-life care is expensive, with the median cost of a private room in a nursing home exceeding $100,000 a year. Many boomers will have to liquidate their assets just to pay for their own care. Then we have to look at physical property. There is roughly $23 trillion tied up in real estate. But a wave of cheap homes for first-time buyers is unlikely. Seniors are increasingly choosing to age in place. They are holding on to their properties for longer periods, which keeps those homes out of the housing supply. When these homes are eventually passed down, the process is often messy. A single property is usually split among multiple heirs, who often end up forcing a sale just to divide the cash. This creates an opening for institutional investors. These corporations leverage their access to cash to buy up family homes, often converting them into permanent rentals. This creates a double squeeze on middle-class wealth. Family assets are liquidated to pay for medical care, and the real estate is sold to corporate buyers, moving that equity out of the family tree and into the healthcare and private equity sectors. For the liquid assets that do survive medical bills and forced sales, the next hurdle is the tax code. Starting in 2026, the federal estate tax exemption increases to $15 million per person. This shields the ultra-rich and makes federal estate taxes largely irrelevant for the vast majority of families. This graph illustrates the one complex tax rule heirs actually need to understand: the step-up in basis. When an original owner passes away, the taxable baseline of their assets resets to their market value on the date of death. This reset shields heirs from paying taxes on decades of appreciation. If you sell an inherited asset immediately at that new stepped-up value, you walk away with a near-zero tax bill. But keeping the IRS away is only half the battle. Heirs who successfully navigate the tax traps often face sudden wealth syndrome, a mix of guilt and lifestyle inflation that can drain an inheritance quickly. Failing to manage the emotional reaction to a windfall can deplete a family's wealth just as fast as any tax or medical bill. When we reach the bottom of the funnel, after the taxes, the debt, and the healthcare costs are paid, the actual wealth transfer over the next 20 years is a fraction of that original $124 trillion figure. Visa estimates that only about $36 trillion will actually transfer to heirs over the next 2 decades, and nearly 75% of that remaining $36 trillion is going to households that are already financially secure. This concentration of funds means the great wealth transfer primarily functions as a mechanism for reinforcing and widening wealth inequality. This harsh reality requires grounded expectations. You simply cannot rely on an aging relative's bank account to fix your own personal finances. True wealth is built by investing early and consistently, entirely independent of a potential inheritance. If an inheritance does arrive, it should be treated as a bonus to be parked safely, not the foundation of your long-term plan. Are you expecting the great wealth transfer to impact your own family? Let us know in the comments below. And if you found this breakdown helpful today, be sure to like, share, and subscribe to our channel for more deep dives.